Hey guys, hope you're doing well out there. Netflix just reported their Q4 results. We'll jump into the numbers from this most recent quarter. We'll also take a look at their Q1 forecast for the current quarter we're in, dissect all the financials for you, and then as always, take a look at the stock chart. This one has been making a very beautiful and very predictable uptrending channel. We'll see where this one is headed and then point out some levels where I think you can be a buyer in shares of Netflix. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below for more earnings breakdowns just like this one. Let's not waste any more time. Netflix kicking off tech earnings with a bang, shares rising nearly 8% in the after hours, breaking over 52-week highs, now trading closer to $532 a share. The stock is up nearly 36% over the past 1 year and has a market cap now ballooned over $200 billion. So keep that in mind as we walk through these financials, which in my opinion are pretty fantastic. Netflix revenues coming in at $8.83 billion. That was good for 12.5% growth year over year. That did beat estimates on Wall Street by $120 million. The bottom line coming in at $2.11. That was a miss of 11 cents. Over at Netflix, we're once again getting back to extremely strong revenue growth. This was a company that was basically flat on a revenue growth for the past, we'll call it 3 to 4 quarters. You see Q4 of 2022, they were at just 2% revenue growth. That has now accelerated all the way up to 12.5% revenue growth. And then for the next quarter in Q1, which is actually the current quarter we're in, they're expecting 13.2% revenue growth. And so you look at it over the past 4 quarters, the revenue growth has been accelerating. And that is certainly what investors like to see over at Netflix. This company really, again, was flatlined from a revenue perspective, once again accelerating those revenues to mid double digits percent. That is lovely to see. Also over at the operating margins, those are continuing to expand. Last year we were at 7% operating margins. This quarter we came in at nearly 17% operating margins. Quarter over quarter is a decline. Seems like their fourth quarter they tend to spend more on marketing, which hurts their operating margins. But again, year over year, substantial increase. And then for the next quarter, expected to once again get back to mid 20s% on those operating margins, up to 26.2%. EPS also massive increase year over year, up from 12 cents all the way up to $2.11 next quarter, expecting $4.49. That was ahead of estimates over on Wall Street, at least on the EPS side. Wall Street was expecting EPS to come in at $4.14. That would still be growth of nearly 44% year over year. Netflix now just said they are expecting EPS of $4.49. So yeah, EPS growth of over 50% over at Netflix in the upcoming Q1. That is fantastic guidance. On that revenue side for this Q1, $9.2 billion is what Netflix is saying. That is roughly in line with the estimates over on Wall Street, closer to $9.26 billion. That would be 13.5% growth year over year. And then even for Q2, you see this one is still continued to accelerate on that revenue side up to 15.5%. And then it's expected to kind of flatline in that mid double digits grower on that top line. Very good to see over at Netflix. Basically, their slowest growth days seems like those are behind them. In my opinion, I would say there's 3 main catalysts fueling growth over at Netflix. The first one being their crackdown on password sharing. Clearly, that's working as they're seeing a ton of new paid additions on their members side. And so that crackdown on password sharing, users aren't really able to share passwords like they were in the past. Seems like more users are choosing to then sign up for their own Netflix account. The second reason, again, fueling this extreme strong growth on that top line, is a shift to that ad tier plan. Certainly that is helping average revenue or ARPU over at Netflix. And so as you have more members moving on to that ad tier subscription plan, that is helping their average revenue per user. And then the last thing I think is just a very strong a slate of content coming over at Netflix. They have extremely strong content still being produced at Netflix, and that is, again, I think, continuing to draw users in and see those new net paid additions keep coming onto their platform. Now, this did come out today. Netflix did sign the rights to WWE Raw starting in 2025, and so it seems like the streaming media or Netflix will become the exclusive home of TKO Group's WWE Raw in US, Canada, and basically a bunch of other countries over time. That will begin January of 2025. I was never a big fan of WWE Raw, never really watched it myself, but I'm sure it's quite popular. And since inception in 1993, WWE Raw has been on linear television and now finally coming to Netflix. The deal is slated to last 10 years and is worth in excess of $5 billion. Keep in mind, this is a company over $200 billion in market cap. So $5 billion over, especially over the course of 10 years, not really that monumental to Netflix. Certainly is a big deal. Still, $5 billion is $5 billion over at Netflix. But again, over the course of 10 years, not really that big of a deal. I think the biggest deal of this is the fact that it's moving away from linear television, that is WWE Raw, moving away from linear television, coming on to a streaming platform like Netflix. Netflix in this quarter did look ahead and say the company is looking to continue to invest in their strong slate of content. And then in terms of acquisition talks, they did say when it comes to acquiring linear assets, Netflix is not interested. And it seems like that's the correct move, or basically the right path to go down, as linear assets are basically coming on to Netflix rather than Netflix having to go out and acquire them outright. I think that's the correct move, and that's really where the industry is headed in the near future. I think linear TV will continue to come over to streaming platforms like a Netflix. Now, in terms of regional breakdown, you see United States and Canada, very strong quarter, 2.8 million net paid additions. That was their fastest quarter from a net paid additions in the last 4 or 5 quarters. Year-over-year growth 3% on that average revenue per member, so they're able to continue to squeeze just a little bit more average revenue per paid user. Similar story over in Europe and the Middle East. Again, 5 million net paid additions, extremely strong quarter. Continued to seeing year-over-year growth on that ARPU side. Similar story in Latin America, 4% growth on that ARPU, and then 2.3 million net paid additions. Over in APAC, they did see a decline in average revenue per user. Seems like that is basically where the market is tapping out on that average revenue side, closer to $7.30. But they did see a very strong rise in net paid additions, nearly 3 million new net paid additions in Asia Pacific. So overall, users growing quite strongly, and then they're able to squeeze just a little bit more out of those users as well. They really haven't done a price increase, I believe, over the past 18 months. And so they're looking to just gain additional new paid additions, and then maybe sometime down the road, they'll look to incrementally bump up the price for those members. Moving on to the statement of operations, on the left-hand side, we have the most recent quarter, so $8.83 billion worth of revenue. That cost $5.3 billion to generate. Last year, you actually spent $5.4 billion in order to generate just $7.8 billion. And so there you see the operating margins really kicking in for Netflix, generating an additional $1 billion while spending less on those cost of revenues. Marketing also ticking up a fair amount. You see quarter over quarter, it's a substantial increase. Seems like their Q4 is a big marketing spend. Technology and development staying basically flat year over year, and then G&A up roughly 10% year over year. And so your operating income coming in at $1.5 billion. Last year, you were at just $500 million, nearly tripling year over year on that operating income side. Again, EPS, not even comparable. Last year, you were at 12 cents. Now you're coming in at $2.11. Shares outstanding have been going down. We'll take a look at Netflix's cash flows. They have a buyback in place, and so those weighted shares outstanding have been decreasing. In terms of their balance sheet, cash and cash equivalents coming in at $7.1 billion. Last year, you were at just $5.2 billion. Most of their most of the assets are tied within these content assets at over $31.5 billion. Certainly, this is extremely valuable over at Netflix. Probably deserves a slight premium if you were to just basically put these out in the open market, similar to how Foundries and basically property, plant, and equipment is for TSM, extremely valuable and difficult to really build up. That's pretty much what content assets are over at Netflix. So these $31.5 billion probably worth a little more if you were to break it out. In terms of liabilities, not a whole lot. Basically have their current liabilities sitting in terms of cash, and then long-term debt coming in at $14.1 billion. A fair amount, but again, nothing to be overly concerned about over at Netflix. In terms of cash flows, we pull down nearly a $1 billion net income figure. That's, again, just for 3 months. For 12 months, you're sitting at $5.4 billion worth of net income. You get to add back some depreciation and amortization. Stock-based compensation coming in at $82.5 million. Last year, you were actually at $153 million of stock-based compensation. And so it's good to see Netflix right-sizing that stock-based compensation expense, as they've basically right-sized their cost structure, even on a 12-month basis. That is down year over year. That is lovely to see from an operating perspective. Operating cash flows coming in at $1.6 billion for 3 months. Again, for the full year, over $7 billion in terms of operating cash flows. They continue to invest in property and equipment, not a bad thing, especially over at Netflix, and then continue to buy back shares. Not sure if that's the best use of their cash, but hey, they have a ton of it. They bought back roughly $2.5 billion worth of shares in the most recent quarter. you see over the last 12 months have added roughly $2 billion onto their cash pile. And so Netflix continuing to just chug along, operate extremely well, add onto their cash balance, continue to buy back shares, and then continue to invest in property, equipment, content, all the great things that you like to see over at Netflix. Moving on to the technicals, Netflix has been making a beautiful uptrending channel since really back in May of 2022. It hit its lows closer to $170 a share. Since then, has done nothing but channel higher in a very beautiful and predictable manner. There's no reason for me to think this one won't continue to do so. I see it coming here closer to $600 a share, where it likely would come in here and get rejected. I think the momentum in this one will carry it higher, closer to 600 in the short term, but then I think you can expect this to get rejected, trade closer to the lower end of this channel, and then probably continue to head higher. If you are absolutely dying to get into shares of Netflix, I think we'll call it $500 is your first entry point. That's basically in the middle of this channel. I think anytime you're closer to the middle of the channel, you can likely step in and maybe nibble on shares if you're absolutely wanting to get into shares of Netflix. I would be more interested near the lower end of this channel, closer to $440, $430 a share. Really anywhere underneath 450 is where I would look to aggressively pick up shares of Netflix. Certainly you do have a level of support down here underneath 400, but honestly, I think this one will continue to channel higher over the long term. I think right now is not the best entry point. Personally, in my opinion, I would wait for a deeper pullback closer to 460. South of 450 is where I would really be interested in picking up shares of Netflix. Really over the long term, I think this channel is where you would look to buy shares of Netflix near the lower end of it. All things looking good over at Netflix. This most recent quarter was fantastic, and then guidance was again fantastic over at Netflix. They're expected to see an acceleration in revenue growth, and then once again operating margins trending back up to 25-26% in the subsequent few quarters. That was my take on Netflix. This one will likely continue to move higher, maybe in the short term, as the momentum really carries it up. Not the best entry point in my opinion. I would wait for a pullback closer to 450. That is really where I would look to load into shares of Netflix. Hopefully you enjoyed today's video. We'll be back again with more tech earnings on this channel. Hit that like and subscribe button below. Thanks so much for listening, and I'll catch you guys in the next video.